Hello everyone, welcome. Hi Ray. We have Marcus, Jerome, JT, and Kayong here, and myself, Jim. As one of the trading legends around the world, which have been known around the world, actually we are very honored to have you here with us. Yeah. Is it okay if you tell a bit about yourself?
Oh, all right. Well, I'm an old man. I'm 73. I've been in the market since I was in university. So that's going back 40, 50 years. I ran a private hedge fund, limited partnership hedge fund until 2010. Took 20 mil to, I think, I can't remember now, close to $1 billion. And since then, I've been running an education program.
Okay, yeah. So actually today, we actually organized this particular conference is that we have we are very active in the social media, especially in different groups. So of investing and trading. And recently it's actually very scary that during this virus lockdown, we see a lot of people, they are showing extreme excitement, rushing into the markets, asking questions like, what do you think I can buy now? Or what do you think of this stock or that stock? Or can I buy oil now? Yeah, so while the answer is a very simple yes and no, but we all know that as a seasoned trader, without proper trading strategy, the consequences can be very disastrous. Yeah. So the objective of this conference is to make sure that we share the right message out to all the retails and part-time traders and investors also, so that they can make better and sound decisions. Yeah. So the very first question that I would like to ask Marcus and Ray. Yeah. We would like to ask you, with the recent plunge in the market, has the financial market correction ended? Maybe I start with Marcus first.
Okay, that's a question that we all are asking ourselves, and it's what we call a billion-dollar question. Now, based on what I have personally experienced in year 2008, of course, this is far a lot less compared to Ray's experience in several financial crises. But the one in Lehman Brothers, the one in 2008, was something that I've already actively trading full time. There were lots of moments that I remember I was very excited calling it bottom. Then followed by a dead cat bounce, and then subsequently followed by disappointment, loss cuttings, and then going in again, thinking that yes, this time round is different, this time round is bottom, and then I got hit again and again over just that few short period of weeks. And I remember it was a very, very painful experience. So this time round, with the COVID-19, especially when the situation escalated a lot more worse in New York over the past 2-3 weeks ago, followed by the unemployment rate that is very scary. And suddenly you see Dow Jones, S&P, and Nasdaq start plunging, and followed by the global stock market. And what was very worrying was the last non-farm payroll, where it hit a record high of unemployment, and unemployment rate went sky high. And yet, following the last week, the market actually rallied, and it was recorded as the best week since 1978 or something like this. So when I read this, plus all the friends in social media shouting, going to buy, it's very worrying, because for me personally, I think that this drop recently, the sharp drop recently, is just a reaction from the market. However, the real brute force of it has not been seen yet. For example, the very first thing that I would like to see, or it's not that I like to see, that it should happen, is that what is the impact of all this unemployment rate? Unemployment. It will immediately leads to, the first thing I can think of is the mortgage. The mortgages, the house mortgages won't be able to pay it off. There will be some defaults and so on. And can the banks, the mortgage banks, sustain such defaults? Last time, during Lehman Brothers time, there were a lot of CDOs, the collateral debts obligation, that leads to domino effect, that very few people knew. So this time round, was there CDOs? Perhaps not as much, but what is the impacts of all these defaults? And what about the defaults at the country level? Because we know that several countries from the third world to the developed economies, many countries has already committed to rescue the economy, spend a lot of their reserve. What were all these impacts to the country at their reserve level, at their central bank level? So we have not seen all this yet. All this thing has not surfaced. So this is something that I would not call it a bottom unless we see clear sign of this particular area, especially defaults at the corporate level, and hopefully not at the country level, because if it happens, it's very scary. And one of the indicators that I'll be monitoring very closely are the bonds issued by the respective countries. If the bond suddenly shoot higher than 7%, you start to see things like this. This is going to be very scary. Yeah, that's my take about whether it is bottom or not.
Okay, Ray, how do you see the recent market correction?
Well, I'm more of a technical trader. I don't look at fundamentals as much, although I must say that I think we won't get out of this mess until they find a vaccine to the virus, because it's not a financial mess, it's a health issue. But if I can just show you the way I look at it, I'll just show you some chart of the Dow Jones. So I've got the matter going back. Yep. Well, this is a weekly chart of the Dow Jones going back from the depression, the bottom of the depression, rallying up to the present moment. And you can see that this drop here is greater than any other drop in history in terms from 1937. This is a logarithmic chart, right? So if we put some swing charts on it, that's what I use to define the various types of trends. The red line represents the monthly trend, the black line, the quarterly trend. And you'll see that we've taken out that low on a quarterly basis. So whatever you've got at the moment on a quarterly basis, you don't have an uptrend. You can have a sideways trend or the start of a downtrend, but you no longer have an uptrend because you don't have higher highs and higher lows. That's been broken. We go to the 12 monthly chart, which is the green line, and we see exactly the same thing, that the 12 monthly trend has broken because we've taken out a previous 12 monthly low. So again, whatever you might have, you don't have a uptrend on the monthly chart. So what I've done here is I've taken a yearly chart, and the blue lines represent the 5-yearly trend, and the gray lines represent the yearly trend. And as you can see, the 5-yearly trend for me has peaked. A little bit of Elliott. Wave 1 is equal to wave 5. Wave 3 is the longest wave, etc. You can see that this has pulled back. So my target for this down move is somewhere in this region of wave 3 and 4, which is between about 14,000 and 6,000. So if you ask me what I think of this current bottom, I think it's just a correction in the first leg of a downtrend. Now, where can I be wrong? For me, this market will probably trace all the way back up to this area, except for the Russell. This is the Russell here. You can see it hasn't done even 50%. The other two indices, that's the Dow on the bottom, sorry, S&P on the bottom, and the Dow on the right-hand side, they have done 50% retracements. The NASDAQ is the strongest. It's gone through the 55%, but I'm looking for it to get up to these 78.6 and 67% retracement levels where there has been previous resistance. So for me, that's where I'll be looking to take a short. So I think we're going to get quite still a step move back, still a move up in terms of the S&P and the Dow. And this area, we have to be careful. I can be wrong that the market won't get up there. So this 55% area is going to be important. And what's happening for me is that when is the sentiment going to change is when the earnings start coming out. We're getting some earnings out due this week and next week, which are really important, and they're going to be disappointing. There's no way that the earnings are going to show a robust simply because of what's happened. So I would be expecting some sort of down leg when the earnings come out, perhaps one more leg up, but that to me represents this area for the S&Ps and the Dow represents the best place to go short. If we take that out, if we take out the 78.6, then one or two things are happening. Firstly, this is going to form a sideways pattern, or this has been a correction and we're going in the 5-year trend, and this is going to go higher. I rate that as about a 10% chance that we're going to go higher. I rate the sideways pattern probably is about a 30% chance and a 60% chance that the market will come down off these, sorry, the Dow Jones and the S&Ps will come down off these levels. The NASDAQ will probably break through and the Russell won't get there. So that's where I'm coming from.
Okay, so actually based on those the charts you show us and the market you show us, right? We actually have investors and traders who are very comfortable with actually taking risks. That means some of them can even borrow from the banks to actually start to invest, and then they are going like all in like that. So from there, okay, with your charts, what is your advice strategy for them or for a long-term basis? What would be your suggestion?
Well, first off, we have to sound the warning, right? This is my personal view, blah, 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 no liability, et cetera, et cetera. Because I'm bearish, I don't know whether your investors are going to go short or whether they just go long. So if always, for me, I always remember three things. I need a method, I need money management, risk management, and I need to have the winning psychology to execute consistently, whether I'm a long-term investor or short-term. If I were looking to get into the market because I'm prepared to go short, whether stocks, CFDs, futures, options, whatever you use to execute, as I said, my area would be for the S&P and the Dow, which to me represent the best structure, would be that 78.6 to 67% if it can get there. I'll be watching how the market reacts to the earnings very carefully this week. If I see good, strong momentum to the downside, I might start taking some preliminary shorts. But whatever you do, you want to me, you have to reduce the size of the position because the volatilities increase so much. So for example, prior to this, the range on the S&Ps were about 25 to 30 points a day. Well, you know, what are we talking now? We're talking maybe 200 points. So I think you need to reduce your position size to cope with the increased volatility. It's all very well to borrow from the bank, but you got to pay it back. And if you lose all that money, where is it going to come from, right? So the best opportunity would be for the market to get up to that 78.6 and 67. By then, I think she'll be ready to turn around because the bad news should start filtering in that the economy is not as good as people think it's going to be. If you're not going to be short, if you're not, the type of person that doesn't like to go short, I don't know who your clients are, then cash, that's literally cash and nothing to do with the markets, but my wife and I have taken out 1 month's worth of expenditure just in case the banks close. I don't think the banks will go broke, but my experience has been that banks can stop saying, okay, you can only take $250 out a week or whatever it might be, or they might just close for a month and you can't even go to the ATM to take out money. So I would keep some cash in the house just in case something like that happens if the worst comes to the worst. I think that's the best advice I can give your clients.
Other than the indexes that you see, any other sectors or instruments that anyone should avoid now or they should?
Well, I think for me, crude has got to be one of the, again, it's a misalignment. The demand and the problem with crude is the demand. There's insufficient demand for oil. With all the industries coming down, there's no demand for oil. Cutting supply is not going to solve the problem. This is like the government's throwing money like they did in Lehman Brothers and so on, because that was a financial problem. This is not a financial problem. They have to find a vaccine. Similarly with crude, they've got the economy has got to get back up and running again in order for people to have the demand for crude. But if you don't have a demand for crude, doesn't matter how much you've stopped the supply, its prices aren't going to go up. So again, with crude, I'm looking for places to go short. I think gold's going to rally. If you in Hong Kong, we got gold bus, and anybody who wants to buy gold, I would reduce your position size, know where your stop is. But gold, I think, is a good buy, but you need to pick your spots. That's about all I can.
Hi Ray, my name is JT. Hi. Unfortunately, I'm in a market that's long only. Most of the people that I talk to, and they are basically in the equity markets, we we're in the Malaysian markets. What advice do you have for us for those that's only long? And I know you mentioned that for long only, basically we are looking at cash as the best way to move forward. But is there any way for us to allocate our money a lot more efficiently than just to put them in a fixed deposit or cash?
Well, I wouldn't put it in fixed deposit because you're not going to get any interest, right? I think going long in a bear market is dangerous. But if you're going to want to go long, then you have to look at industries that are going to benefit from being kept at home. So I don't know what they might be, but Netflix or something like that, those sort of industries that will benefit from people having to be quarantined at home, at least until the vaccine is discovered. The other thing is I would be looking around if you have that inclination to see if you can find some company that actually is starting to come up with a vaccine, because that company is going to make a lot of money. So they're the two areas that I would be looking for. I'd be looking for an area that can benefit from people being cloistered, and the area where people might find a vaccine. I think there are about 10 possible vaccines at the moment, and I'd be looking at some of those to see which one is most likely to succeed. Now remember, going long in a bear market, you need to make sure that you have an exit strategy. You can always be wrong, and I would reduce position size.
Right. Thank you, Ray. Just a follow-up question. Now, I see that you are more or less on a bear camp. I'm not exactly in a bull camp, but what is the risk or the downside of being in a bear? If you mentioned that the whole bear or the shorting plan is contingent on having the vaccine, and that would mean it's going to be a bull case from now onwards, right? Is it just the vaccine, or is there any other things that we're looking at?
The vaccine, to me, this is a health issue. People can't go back to work. If people can't go back to work, stock markets are eventually going to go down. I mean, there's no way around that issue. The vaccine is at least 12 to 18 months away. So we've got this market being choppy to down for that period. And then we need some time after the vaccine is found for the economy to start again. So you're looking at least 2 or 3 years. So again, when we talked about the Dow chart, I think that we'll probably the bottom around 10,000 on the Dow. Well, we're trading, what, 122, or what are we trading at the moment on the Dow? 25,000 or 23,000, something like that. Well, that's 10,000 points away. So it's, how am I going to put it? I find it very, unless the market can take out the 78.6%, then I'm going to step back and say I'm wrong. Until then, I'm going to stay with the bear camp. And I think that it's very, very hard to give advice on the bull side. I'm sorry.
So you only be bullish when there's a vaccine out, is it?
Well, I'll only be bullish when I can see that we're going to be allowed out and going back to work. And I can't see any way around that at the moment except through a vaccine, because I don't know what it's been like in Malaysia. And are you in Singapore or are you in Malaysia, Jim? Singapore. Well, we've had that second wave, right? You had that, you're managing it okay. I think you guys made a mistake because you wouldn't wear masks, and I think that's why you went ahead of us. But we had it under control in Hong Kong. We had it we're down to about 200 people were infected. We had very few deaths, and then they relaxed. People started mingling again, and we've gone to over 1,000, and then they came back in and started restricting. So the problem is, every time you relax, the thing comes up in a different form or increases again. So until we can find some way of getting out to work, it's all very well for us. We can work with this. What about the guy that manufactures the cars and the lamps? And, how are you going to get industry going if people can't get together? So I think that's the problem, right? So I'm going to be bearish until such time as we can get back to work in some form. Right now, the only way I can see that's through a vaccine. If they find some sort of super duper mask or something, so we'll be running around the factories with all our masks on.
Yeah, because actually right now, every country is trying to find a vaccine also, not just the countries, the companies. Many of the medical companies trying to find a vaccine, yeah? Any companies that you see potential for this vaccine or what?
It's a bit early at the moment. I think there are about 10 of them I've got on my list. I can't remember their names. But if you just Googled, you'll come up with, there are 10 companies out there that are in the process or about to do live testing on humans. They've done the animal bit. So they're the ones I would focus on, because they're the ones that are most likely to break through. But even if they get that, you've still got all your tests and everything I've read about vaccines and what I've learned from the past. It takes about 18 to 21 months. Sorry, 18 to 21 months before, from the time they find it before it gets on the market. So we're not going to get there anytime soon. And I might throw this, I've got to tell you, I'm not a Trump fan, but if he starts going to work in May, getting the people to go to work in May against the medical advice, then the US is going to go backwards quickly, and that's going to cause a delay in the revival of the world economy. I mean, if you were just an idiot in Africa or something, fine. But you know, the United States, we can't afford for the US to go down the grid. And that's scaring me more than anything else. Is scaring me that US will try to go back to work before it's stable and it's safe, in which case they've got the highest death rate now. Well, that's probably going to increase dramatically if he pushes this nonsense through. And he was talking about sacking Fauci, for goodness sake. I mean, sorry, don't get me started. We won't be talking about the markets, we'll be talking about Trump.
Okay, in fact, I have input for JT. JT, you asked just now what are the things that if somebody want to long, that's where I'm going to come back to Forex, because that is an area that I almost now close to 90% of my trades are in Forex. JT, that is where you can still long, you can choose the right pair. But something that is very interesting that I observed, that because of the wild volatilities, the spreads are getting a little bit unpredictable, especially on those pairs that are not so popular. For example, if you have a pound Kiwi or Euro Kiwi, I start to see extremely high spreads of almost 20 to 30 pips of spread momentarily. So that is going to be very choppy for someone who is not an experienced currency trader. I'm still very active in trading currency, and I rely a lot on this thing called money management and risk management. Ray, if you recall, many years ago when I met with you in Hong Kong and prior to that in Singapore, we emphasized a lot on this thing called risk management. And from your book and some of your articles that you contributed, risk management is always a priority in every time before you even place a trade. For us, within our community, it's not just a warning about risk management first before you place an entry. We even design dashboards to pre-calculate the lot size, the contract size that you are allowed to trade based on your available equities before you place a trade. So that is something that I personally vouch to it, and until today, I use a lot. My last few trades of shorting or long dollar. Currently, I have a few positions of shorting US dollar, and that's has got easily 100 to 200 pips of profit. But whatever it is, not just looking at the profit, especially for those who are listening in, it's not about that there are lots of profits for them to take, but there are still very, very choppy, a lot of risk out there. So for any of you, whether you are trading stocks or currencies or commodities, always remember, know where your stops are, where the levels of stop loss are, and then calculate what are the suitable contract size that you're comfortable to lose first before you decide to enter. Yeah, that is something that I always like to emphasize to all those who are getting very excited out there. Find the stop loss, because we can be wrong. Even for those who want to short, we can be wrong also. It could be a very solid dead cat bounce all the way to way above 50% to the level of what Ray mentioned just now, 78.6. That will be suddenly a lot of us will be knocked off the table from the bear camp table. But anything can happen right now. It's just that from that fundamental perspective, I still feel that the ugly side, the true problem of the economy has not surfaced yet. What we see is the impact of the health issue, but not yet the economic issue.
I was just going to add, I agree with you entirely. I think this business of risk management, position sizing, especially when the volatility has increased, is critical to our survival. You only have to be wrong once without a stop or a size. That's look at Lehman Brothers, not Lehman Brothers, long-term capital management. I mean, these guys were the best of the best, and they blew up because they didn't manage their risk. They didn't manage the position sizing. And what I always say whenever we're talking at a public presentation, because I emphasize position sizing relative to the volatility of the market. It's really critical because you look, it's not that you can be wrong. I guarantee you'll be wrong, right? There's no way that some of these people come and say 100% winning. Bullshit, excuse the word. It's just crap. We will lose money. The important thing is to lose less than you make. It's as simple and as hard as that.
No, yeah. Actually, no, since we are on the topic of risk management, sorry, we were at the topic of US dollar. So I understand that we are talking about risk management right now, and I feel that the risk management for equity side is actually very similar to what we see from the forex side, which I understand a lot of you guys are in right now. So I'm just gonna leave it at that. I think those are great advice. The only thing that we can do as traders, as investors, is basically just to adhere to those basic principles of risk management. No, these are really what we consider the boring side of trading and investing, but at the same time the most important part. Yeah, that I totally agree. My question is actually more towards the dollar side. It's interesting that I heard Marcus say that he's actually on the he's actually shorting or bearing on the bear side of the US dollar value. So this led me to think about the QE unlimited, the unlimited QE versus the 2 trillion stimulus package by the US side. What are the kinds of short-term impact and the long-term effects of these two plans that the US have right now that Marcus or Ray can comment on?
Okay, US being the world currency, even though its position is shaken. But one thing that is very interesting is that every time I observe that there is a sudden news, the thing that takes the lead is actually the sentiment. So people will always rush to dollar by liquidating whatever positions they have out there. So they will rush back repatriation of into the US dollar. So it will always go up on bullish trend for a while. But that pledge of 2 trillion, or in fact, it is almost a QE unlimited again, or QE forever, will eventually still dilute the value of US dollar. But having said that, the rest of the other countries, like for example in Singapore, in Malaysia, these are the countries that we stay in, you will start seeing government or the central banks diluting or easing, exercising their easing policies into their currency. So there will be lots of seesaw. So JT, just to be very, very clear on dollar, it's not about the short, it's not about the bearish trend for US dollar throughout. It's going to still have that volatilities that's going up and down. It's just that every time all these trades, we need to be very clear of where our stop loss level are, and also be very, very clear on where we want to take profit. Sometimes taking the money away from the table is actually better than hoping that it will go for a super few thousands of pips of profits. I'll rather take the money from the table first. Yeah, I think this part here, maybe Kayong will have some inputs on US dollar. He does a lot of research on that.
Right. For me, I feel that the US dollar for the past, maybe when the impact hit immediately, we saw the strengthening of it. I think that is really due to US to act as a reserve, a global reserve. But what I foresee is that eventually the US dollar will weaken quite significantly. And some positions that I'll be monitoring very closely in the FX market will be mainly the dollar against the Canadian, and of course Australia against the US dollar. Mainly, I'm taking a bear side on the US dollar, simply because when things starts to pick back up, that's where people will realize and kind of see that there's a lot of supply of the US dollar in the market because of the stimulus package of printing and everything. So yeah, that's my view on US dollar in terms of from now to maybe longer term perspective, within the next 6 months to 1 year. that's where I view the US dollar is likely going to weaken. Again, I might be wrong, but that's my perspective moving forward. I'll be more interested to kind of like spot for opportunities to short the US dollar compared to buying it up.
For Ray, you have anything about regarding the US dollar or?
I find for me, Forex is always a function of what pair we're talking about. So, Jen, for example, sterling US, I'm actually bearish the sterling against the US. Dollar CAD, I'm bearish the US against the Canadian dollar. So it's very hard for me to speak about the US as one currency because for me, it's depending on what pair you're talking about. So I'll stay out of the conversation because I have no idea what you're talking, which pair you're talking about.
Yeah, but these are the two pairs that Ray mentioned. I have positions long on pound dollar and short on dollar CAD. But it's all about weakening US dollar for this point in time.
For the moment.
Maybe I throw a different perspective of a question. There are also people who I can see on social media that picking up blue chip stocks, like especially the banks that pay high dividend historically. Would it be wise to start collecting bit by bit?
No, my view is that we're going to be in for a correction. We're talking the Dow, what, 22,000 down to 10. I mean, if you think of it in those terms, what stock would be a safe buy? I mean, look at Hong Kong Bank for probably one of the best stocks we've got in Hong Kong, and that's come down quite a bit. So overall, I would focus on those, as I said to JT, on those two areas. Whoever discovers a vaccine and those areas where keeping at home, they're going to benefit because they will continue to make money. But just say blue chip stocks in general, no, it's not for me.
Well, now the reason why I'm asking all this is because the context here is that I'm into Malaysian and Singapore equities, and the reason or the ways that we usually make from a strong or a weak dollar is to look for companies that trades largely in the USD terms. So that's exactly why I asked that question. But ultimately, I feel there is also that talk about blue chips and the dividend companies, the yield seekers per se. I'm actually one of those seeking the yields, but I really don't want to comment on what's the direction of the entire equity markets right now, be it 10,000, be it 15, be it even 20 or even 30,000. The point is what we do here as a form of risk management or portfolio management is to dollar average or to value average our position so that we don't go all at once. So what advice or recommendation do you guys have in terms of a slow? Let's assume that we are all dumbed down retail investors who knows very little. What are the very easy ways that we can do to slowly collect, like dollar averaging, dollar cost averaging, and what are the things that is considered foolproof? We understand the risk of going in with a leveraged product. We understand the risk of going in. We might lose money in the short term, maybe in a 2 years period or 3 years time. But over a span of 10 years, 20 years, there are probably some things that us retail investors can do that's considered foolproof. Do you have any comments on that?
I find it hard, JT, because I don't like averaging. I just have never ever added to a losing position. I'd rather be out and go back in. And don't forget, I haven't been in the long side of the stock market now since early 2019 when she had that tumble, because I felt that we were approaching this climax. And I will personally stay out of the stock market unless I see that I'm wrong. But if I'm right, I will be looking for the bottom around 10,000 bases the Dow. I can't talk about the other indexes because I don't have enough history. The Dow will be my guide. So talking about dividends, I mean, it's so hard to say. If the companies start to go down, the ability to pay dividends will be reduced. So you not only have a lack in capital value, you're not getting your dividends. So I'm not, yeah, I'd rather be out and sit back and give a chance and see what happens. Yeah.
Now, if it will correct further or it's going to tank further? Okay, this no right or wrong question, but when will it be? Is it going to be as soon as the next few weeks, or we have to wait for another month or so?
Well, it really, to me, is a function of two things. And this becomes back to fundamentals, what the earnings reports are going to be. If they're as bad as I think they're going to be, the tanking will start probably next week when the more important earnings start to come out. And then I think the killer will be the non-farm payrolls, because if we start getting non-farm payrolls above 1 million, the sentiment is just going to change. And that I think will start the resumption. The 78.6% is my make or break level. If it gets through that, then we are either forming a sideways market, in which case we were not going to get a bear market, we're going to form a sideways market, or this has been a correction in a bull market, which I rate only as a 10% chance. You know, just as a thing, I mean, if you looked at HSBC, going back to HSBC had a high of $150. It's trading $41. And its payment of dividends has gone down accordingly. So unless I'm proven wrong, I'm bearish, and I will prefer to go on the short side of things. Otherwise, I'll just stay in cash. Unless you find this guy that develops the vaccine. That if you can find whoever develops the vaccine, you'll be a millionaire. I mean, seriously, if you focus on that, you may actually get because there are only 10 companies. It's just that I don't have the time to devote myself to try and keep track of 10 companies to see who develops it first.
I think I remember reading Johnson & Johnson being one of them.
Yeah, I really haven't. I got my PA to do the thing, and she's got 10 companies listed for me, and I'm supposed to have a look at it at the end of the week. So we'll see what she's done. But just as a matter of interest, yeah.
One last question from me. I think after this, I'm dried up. Okay, for this period where there is quite a significant gap towards the 78% retracement level, would you suggest that we go in to dabble around in the market for maybe a quick long positions? Are you into that kind of strategies?
Sorry, say that again. I missed
right. So there is still a quite significant gap between current prices, current levels, towards the key level where you'll be watching for a short trade. As of right now, this short period, would you suggest for us retail to go in dabble a little bit?
Well, that's a matter of your trading style, right? I mean, if you're a swing trader, like I tend to trade the monthly trend. So I will never, ever go against the monthly trend, whatever that might be. So at this stage, the monthly trend is down. So I would rather sit back and let the market rally without me. We caught very close, maybe about 100 pips off the lows. And I've missed all this up move. And if it goes to the 78.6, I would have missed a lot of money. But I could be wrong about where it's going to go. And if it turns around savagely, you see, you wake up one morning and it's gapped down 200 or 300 points. What am I going to do with I trade mainly futures and CFDs. What am I going to do with that loss? So I prefer not to take that sort of risk. So, but again, that's a matter of your trading time frame and your style. I mean, some people are prepared to do that.
Like for us, we have many traders who are actually very impatient. They try to trade every movement in the market. But for you, it's very different. You can.
Yeah, right.
Yeah.
Well, I know what I have to do for me to make money, and that's fine. I cannot trade every little squiggle because it's just not my style.
Yeah. Kayong, you have anything to add?
Okay, maybe one interesting thing that maybe we can actually input to the audience that's watching, mainly for those who are, I would say, very new, but because of the excitement that they might hear on social media, their friends sharing about now is the golden opportunity. What would be that one key advice that to safeguard them and not having them to just jump onto the bandwagon of excitement simply because they hear it from social media, they're afraid of missing out. What would be one key message that maybe to send this to them so that to safeguard their finances as well?
Well, I think the message is pretty blunt. You can go broke. I mean, if you're trading futures or CFDs, you can go bankrupt. Hey, this is happens. I was at a conference run by Commonwealth Bank about 6 years ago, and I met a gentleman there who said, I said, why are you here? You know, just chit chat. And he said, well, I've gone bankrupt and I've lost my wife trading futures. And I thought, that is really, really sad. But that is the reality. People think you can go into this market without an education and I'm going to buy here and I don't worry about risk management, et cetera, et cetera. And then they wonder why they've lost their funds. If you can get that across, that it's actually a profession that is very dangerous to your way of living, but if you get an education and you learn about what to do, then it's actually quite a reasonable way of earning additional income. But it's not going to make you rich overnight, and it's not going to make you rich without any effort. To me, trading is the hardest profession in the world because it's against our human nature. Who wants to take a loss? And yet we need to do that. We need to take a loss. You know, the old story, oh, if I hadn't cut the position, I'd now be a millionaire. You know, you're long and the market goes down, stops you out, and then she takes off. They remember that. They remember that occasion once, but they forget the 100 times that if they hadn't stopped out, they would have lost their shirts. So I'm all for something like this and this sort of gathering for people to understand that trading is difficult. It requires effort and work. It is rewarding. I mean, think about it this way. I always like to put it this way. Where do you get 90% of the population putting money in your pocket? Only in trading. Your competitors are actually putting money in your pocket because, you know, for every winner, there's a loser, etc. So if you do it, you don't even have to do it fantastically well. As long as you're competent, you keep to your risk management, you keep to a consistent way of executing so you know what you need to change, you will make money. How much money is a function of your ability and your discipline. If you don't have those, you can easily go broke. That's the message I'd be trying to get across.
How long do you take to be profitable for your?
You're asking how long I took to be profitable? You want to know? Took me about 10 years. Seriously, I sold my legal practice in 2000. When did I sold my practice in 1980, and my first profitable year was 1990.
1990.
No, 1987. Sorry, 1987 was my first profitable year. 7 years it took me. I've got a friend who I met in Singapore because I was doing some coaching, and I always took if you applied for a coaching position, one of my coachees, I would get you to do a test, and the test came back and said, don't touch this guy with a 10-foot pole. He won't be able to do it. He wants to get rich quick. So I said to him, sorry, Peter, I can't take you. And he became my best friend. That was 12 years ago. He's still trying to make money out of the markets. So that's the thing. I've got one guy who's taken never traded before. He's an electrical engineer, 4 months. And he's now, the last 6 weeks, he's been making very consistent with his trading. And he's been, in this environment, he's been making money, which is really good to see. So it really depends on you. It really depends on the person. There's no ifs and buts. Normally, I would say it take you 4 or 5 years.
I thought it was a pretty interesting comment. I mean, you are an educator yourself. Do you believe in nature more than nurture itself? Because as educators, we feel that maybe we are nurturers, right? We nurture them to become better traders over time. Maybe perhaps in a reasonable time frame, like 2 or 3 years time. But within 12 years, if you can't make money, that is a question of nature. And if they can't make it,
but don't forget that people who take 10 and 12 years are people who don't want to change. In my day, I have an excuse. I had to teach myself. Nowadays, there are a lot of good educators out there. If you take that long to change, and I have seen people, they just will not change their pattern of behavior. Like in this case, my friend, as long as he doesn't sit in front of the screen, he's fine. But the moment he sees the markets going up and down, he gets excited, and then all discipline goes, and that's the end of your trading. You know, he loses money, loses all the profits, loses all the capital. goes back for 3 or 4 months, doesn't trade, then goes back into it, and the same pattern all over again. So in his case, nothing we can do unless he's willing to make that change. Other people like Jody, this guy that I'm talking to, this electrical engineer, he's prepared to do whatever it takes. If I said, you got to get up at 4 in the morning and go run around the block, he'll get up at 4 in the morning and run around the block. That kind of guy is easy to teach because he's willing to do whatever it takes. So it just depends. It's part of its personality, but I think more than anything else, it's a commitment to change your behavior. And that is the person who succeeds in trading.
So these 7 years, you have the biggest takeaway to all our clients and our students is the commitment to change.
Yeah, it's a commitment to change the right way. Like you talk to people, and I know a guy, a wife came to me 2-3 days ago, and what happened there was she is supporting hubby, very similar to what my wife was doing. And he says, and I said, what does he do? And we chatted, and he says, oh, but he's prepared to change. And what he does is he buys one system after another that promises immediate returns, 100% returns, or 90% returns, put $1,000 in and make $50,000 a day or some bullshit like that. He's not changing. He's just going from one horse to another. You have to commit to change the right way. You've got to find the person or the approach that suits your personality in terms of method. And you need someone to help you with a consistent execution, which is your discipline, your psychology. And then, of course, as Marcus and I were talking about earlier on, risk management is absolutely critical. And you want to have to do it in small bits. The people who want to get immediate results, big immediate results yesterday, will never succeed. The ones who are prepared to do it one step at a time, they're fine. That would be my advice.
I have some input over here that every time when I share with people about this concept called risk management, I always mention I'm a 1% trader. So then I will have to elaborate what is 1% trader. I think Ray, you know very well that every trade that you do, if I lose on that trade, it's going to hit me only 1% of my capital. So that I still have 99% of my money still intact, and I don't feel a pinch about that. But the interesting response that I get from other people is always that, what, after so many years of trading experience, you are still doing 1%. So that is where it's so hard to explain to people that, hey, until you lose your shirts, you lose your pants, then you will appreciate this 1% discipline. So this discipline thing, and back to JT, whether it's a nature or nurture, I think it can be nurtured. But if a person is comfortable with process compliant, like the engineers, I think they're okay. But if the person has got that, the anxiety of getting rich quick, that will be really, really very tough. In fact, we turn away some of the students who want to join our community. The minute they say that, is it 20% a month of profit? That is where we know that is totally off the scale. We are totally from a different country, different language already. But for those, especially the audience who are listening in, it's very important not to have a unrealistic expectation. A realistic expectation for me, for any of the part-timers or beginners, if you can have 10 to 15% a year consistently, I think that will be very, very wonderful already. Ray, what is your target per year? Do you have a expectation on a yearly basis?
Well, I go back to what I've been making, 20-25%, but don't forget I'm a full-time trader.
Yeah.
And I've been in it. I mean, I lost a lot of money and I've been in it a long time. But having said that, last year I had a tough year. I made 8%. I mean, and back in when I first started, I would have lost a lot of capital. I never had a really, one of the, those years where you buy and it goes down, you sell, it goes up. I had one of those years. And that, that's a tough year. And once that passes, then you get the good year. And when you have a tough year, it's going to end. When you have a really good year, it's going to end. Things even itself out. You don't let it get to your head when you're having a really good year, and you don't jump off the gap when you're having a bad year. But as Marcus says, the discipline there to make sure your losses remain as small as possible is absolutely critical for long-term success. So about 20-25%, Marcus.
Great, great. I'm still doing an average of 15. Some good years 20, but on some lousy year on the 7 to 8%. But the important thing is that positive every year. That is very, very crucial. And how that happens is it's not about skill. It's not about luck. It's all about discipline. Process compliance is always very important. But I learned through a very painful way.
We've all lost a lot of money.
Yeah, I blew several accounts in my early years of trading, especially the non-farm payroll when I thought that it's bottom and that's it, go all in again. And another bottom, borrow money on credit cards and go all in again. That's really, really painful. So when I see now over the social media when people got excited and we have friends who literally start borrowing credit cards because the interest rate is much lower, and they went to open brokerage account and these are the people that is very hard to stop them, but the only thing that we can do is probably sharing all these messages that such easy money may not happen if you don't have the right discipline. We still can be wrong, or Ray say we definitely will be wrong when you think that you will be right.
Absolutely.
How to put it better, but that is something that is to let people know, even though you know that is the very moment already, but we still can be wrong. So risk management is still everything. Yeah.
Yeah, and you know, how many times have people blown an account on one trade simply because they don't want to cut their losses?
Yeah.
When I went to Singapore the first time, I was doing a talk at Reuters in those days, and met this lady, and she said she'd shorted the Aussie dollar, I think at 45 cents, 46 cents, near that low. And she had $100,000 account, and she kept rallying against her. And I would say to her whenever we meet, when are you going to take it out? You know, you're losing money. And she just refused. And she eventually blew the whole amount. Now, the broker didn't like it because he got one trade out of it. She didn't like it because she blew her capital.
Yeah.
But people just don't want to take their loss. And it's just, how can I tell you? It's part of the advice you're asking. This business of commitment. Yeah, exactly. I've never known a long-term investor to be one if they're making money. Usually these kind of people, long-term investors, so they're holding a big loss. Or do the other thing I saw when I was in Sydney, long and short at the same time, right? So they don't marry the position off. So that way they never lose because they've always got it hedged, except both sides are losing money. Crazy system.
Yeah, that is also a crazy mentality. They just don't want to face the loss or recognize the loss.
Yep.
And move on to the next one. Yeah, that is very, 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 very important.
And I think those words are critical, Jim, what Marcus said, move on to the next one. Because once the loss is taken, it's finished. You don't have to worry about it anymore. You then move to the next trade and see what that trade can offer you.
Kyle, you have anything for trading, regarding to trading?
No, I'm actually not so much of a long-term investor. But yeah, I'm more active in like in and out, and I perfectly understand and agree to the fact that there will be losses. And it's actually one of the challenge that traders face is to get over the last trade that we took and to actually take every trade that we're going to take as independent and not let emotion and psychology actually affect what has happened in the previous trade, whether is it a winning or a losing. And one thing I always share and also developing myself is actually the part of self-awareness. And this is actually one of the most challenging topic to actually share it out, the message to share it out with people out there, because they simply only focus on strategy, the tactics, the method to actually analyze, and they are only keen in where I'm going to enter, where I'm going to exit, what's my profits. But I find it very challenging to actually send across a message that being self-aware about our emotion, our psychology as this whole trading journey is actually one of the most important aspects to keep working on. And there will be no like, you know, I perfected it. There's no state of that, but it's always a constant work on this part, psychology and mindset. Yeah. So this is something that I feel is very important, but yet is lacking in a lot of retail traders who's trying to come into this industry, and their focus has always only been on strategy, tactics, and methodology. Hopefully, this opportunity also present us the chance to send across a message like this to people who wants to start. Hopefully, they'll be able to start in a proper track. Yeah, Ray, back to you.
Yeah, I was just going to say that there has been a new development in the field of behavioral psychology called acceptance and commitment therapy, or acceptance or commitment training, ACT. Dr. Gary Drayton was the one that introduced me to. He's a trader, psychiatrist, psychologist, and I've certainly incorporated that into my educational program, and that has helped, been very successful. So if you're interested, if you're in that mode, have a look at ACT. The only thing I would be careful with is mostly books that are written on the subject are for other therapists. So you want to get the idea, the general. I think there's a book called The Happiness Trap, which gives you the beginning, and also a book called ACT, a primer. Those two books I'd start with. They give you the general idea, and then you take that and use your own experience. But their concepts are really, really good for trading. And one of the things that they teach you is how to remain balanced. And they use the left and the right brain together, which is, I haven't seen anything like that, because I used to do some cognitive therapy. And that's all left brain, all this thinking about rationally about your emotion, and I think that's very difficult. I think that's one of the flaws of psychology, but these people have put it together, and it's very, very good. So you might want to have a look at that.
I think it's very impressive that until right now you are still trying to constantly improve yourself. It's not
well.
At times when
let me put it this way: trading is a one-on-one game. For every winner, there's a loser. The guys that I'm trading against, they're always trying to improve. If they improve and I stay behind, I'm going to be the loser. Just to keep up, I have to keep improving myself, both in terms of psychology, in terms of risk management, in terms of method. You know, so you have no choice in this game. You can't sit back and say, I've got it all. I've seen. You ever read a guy called Trader Victor Sperando? He wrote a book called Trader Vic. I forgot what he called it. But if you Google Trader Vic, and I learned a lot from him when I was losing money. And then he blew up. He blew the entire hedge fund account because he got to the point where he thought he knew it all. Long-term capital management, exactly the same thing. We know it all. We're the great guys. We're experts. And then they do the things that they ought not to do. I don't think you can ever stop learning if you're going to be a trader. You have to keep improving. There's no other way around it.
Okay, so actually, this is a very insightful conference. Before we end this conference, I would like to conclude. Yeah, so the first one is from Ray is look out for the market is still very bullish, bearish, right? The market is still very bearish, so look out for a medical vaccine. Yeah. So the second one is risk management is still the most important. Risk management and lot sizing is very important at times like this, in order not to actually blow your accounts. The third one is don't do dollar cost averaging. It's always better to get out of the market and then going in at a lower price.
Yeah, that's for me. That's not necessarily for everybody, right? I want to emphasize that. That's just the way I trade.
Okay.
Other people may like dollar cost averaging. I'm not making a comment about what they're doing.
Okay. The fourth one is actually the willingness to change right away so that you can improve and exponent your learning curve. Right? So actually, before I end, because we know actually you're going to trade the UK market, any last words you would like to say to our viewers?
Just be careful. I mean, it's an environment where you can be very lucky and make a lot of money just on one trade. Don't let that go to your head. You know, it can happen. The other way can happen too. The next trade you could be very unlucky and you can lose everything if you don't do what you've just mentioned, manage your risk. So I think the future offers a great environment, if I can put it that way, an opportunity if you trade properly, because volatility will be there. And for me, if there's volatility in the market, it gives me a chance to make money. The worst kind of markets for me are with that grinding sideways type market or grinding up market, where it's very hard to make money. That said, if you don't manage the volatility and you don't manage yourself, you won't make money.
So the most important is to manage yourself, right?
Yeah, absolutely. Well, that's always the case, right? You got money, method, and mind. The mind will always be I always put a multiplication sign. You need mind multiplied by money multiplied by method, because if you have zero in anyone, you won't make money. But at the end of the day, the hardest is the self-awareness, as Carillon was saying, and the mind. The method is relatively easy to find, maybe hard to apply, easy to find. Money management is just a function of stats. Jesus, you put it on a spreadsheet and they'll tell you how much you should be risking per trade given your past results. But doing it, that's the hard part. Doing it is the hard part.
Okay. So thank you, really, thank you, Ray, for your time. We do hope in future we get to meet you face to face and hear from you real soon. Thank you.
Absolutely. Next time I'm in Singapore, you're in Singapore, we'll catch up. I was actually going to be there in April, but I'm not allowed into the country at the moment. Thank you for having me. Take care, guys.
Now, I hope you gain much insight from this conversation that we had with Ray Barros. Now, on top of just, the market outlook and the analysis, I think what's more important for all of us to take away from this conversation is really the risk perspective, the risk management that both Marcus and Ray talk about, right? The importance of it, and definitely the emphasis that is being placed in how we manage our risks for every trade that we enter the market. That's very, very important. And I also hope that you also gain some insights into the experience that both Marcus, Ray, JT, Jim, and myself, where we shared about, trading is not just about the strategy, about where you enter, where you exit, but more importantly, it's really about identifying yourself, knowing about yourself, your emotion, how you handle your psychology. That also affects, the performance of your trading or investment. And one more point that I would like to highlight over here is that trading and investing is not a sprint, okay, and there is definitely effort that you need to put in. But what I want to say is the reward of it, okay, based on the effort that you put in, is definitely worth it. And right now, in this context where the market is affected by COVID-19, and if you're one of those that is afraid of missing out and just jumping in simply because you have the thought or the concept that the investing and trading financial market is a get-rich-quick thing, okay, hope this conversation that we had with Ray is able to give you some perspective into what real trading and investing is really about, right? So to conclude, I hope you really enjoyed and gained much from this conversation over here that we had with Ray Barros. And of course, if you benefit from this, we'll appreciate if you can also share this and help us to reach out to more retail traders and investors, and hope that they can also benefit from this conversation.